My name's Andrew Stotz from Maybank Kim Eng, and today I want to walk you through my latest piece of research. This particular research is a little long, so I'm going to ask you to bear with me. The key thing in this research is that I'm taking 2 stocks out of my portfolio and adding 2 into the portfolio. We'll get to that in just a second. The first section of this report is talking about global asset allocation. And basically what I'm saying is that emerging markets are the best area to be within the globe right now. I look at 3 regions, the first being the US, the second being the the developed markets, non-US, that would be Europe, Japan, Australia, and then I also look at emerging markets. Those are the 3 categories for equities. After the 3 categories for equities, I look at bonds. In particular, I'm looking at US bonds, where rates have been very low. My key conclusion is keep your money in the emerging markets. That's the main place to be. And at some point, bond investment's going to be a losing investment over time because interest rates are so low. So let's get started. This chart starts off, the main line you want to see is the top gray line, which is the emerging markets, and showing that it's been outperforming for a long time. The other interesting line is the dotted line, which is the bond markets. And what you can see is that the bond index has actually outperformed equities over many, many years. Now, why would bonds outperform equity? Well, you can see on this chart that the interest rate related to bonds have been collapsing. That's the orange line here that's fallen down to less than 1% for bond rates. So when interest rates fall like that, bond prices rise. But they can't fall much more, so I think it's not going to stay down forever. So if we take the 3 regions, the first being emerging markets, the second being developed US, and then developed non-US, my feeling from everything I can see is that you should be investing in emerging markets rather than the others. Now, you can look at the price to book right now and see that emerging markets are kind of middle of the road. We have European and other areas where they're dragged down by crisis, and so they're facing some difficulty on valuation. US is a bit expensive at this point, so I would focus on emerging markets. My stoplight system for valuing stocks looks at red, yellow, and green. Try to keep it simple. Where should you be adding allocations and where should you be reducing? And in this case, emerging markets is the place to be adding. Now, what I'd like to talk about is what I call the 4 engines of growth. The 4 engines of growth really in any economy are the consumers, which drive business, and they buy products which cause corporates to need to expand their capacity. They borrow from banks, and then of course the government taxes and spends. Now, if we go through each of these items, I like to look at debt, because debt is something that's very real on the balance sheet or on the balance sheet of individuals. And you can see that the U.S. Consumer has been deleveraging since the peak, but they still got a long way to go along with the Eurozone. Asia is starting to rise, Thailand in particular, but it's far below what you're going to see in the West for right now. Now, debt levels at corporates is kind of significant, because if corporates are in bad shape, they're over leveraged, it's a lot of risk in the economy. Of course, the line that's very high in this one is the 1997 crisis impact on the Thai corporates, where they ended up with a huge amount of debt. They've paid that down, and the most interesting thing on this chart is that the Thai corporates are starting to borrow again. That will drive bank growth, lending growth. And so let's look at banks for a second, because the next area is banks and the quality or the stability of the banking system. And you can see the top line here is Thailand at a very high level, almost about 9% of equity divided by 100 in assets. So about a 9% ratio of equity to assets, much lower in Europe, where they're going to be facing troubles. Now, the last one in this section is just looking at government debt. And as you can see, we've now got government debt starting to exceed its prior peak in the 1950s. This is the disaster waiting to happen in the US and in Europe. And it is not going to happen in Asia, because Asian governments do not have that much debt at all. In the case of Thailand, I'm not worried about it much at all. So if I look at the 3 different regions, the US, Europe, and Asia, I would be focused on Asia because the economy is in much better shape. The other ones, the other markets, are not that cheap, so I'm not allocating that much to those right now. So if we come to Asia, what should we do? Well, my analysis basically looks at a lot of different factors to try to identify, out of 9 major markets in Asia, which one should we be allocating to. and I apply the same stoplight system of red, yellow, and green. And in this case, I come up with Thailand, Indonesia, and Malaysia in that order. Now, this is Asia ex Japan relative to world equity. So the emerging markets are composed largely of Asia, in particular Asia ex Japan, and we can see the outperformance that's happened there. If we look at Thailand, though Thailand's run a bit, we can see that the price to book is only slightly above the long-term average. So I don't consider it a big risk at this point. The same thing in Indonesia. We had a D rating over the last few years, and now we're at about a 3 times price to book, just a little bit above the long-term average. And in the case of Malaysia, we're at slightly over 2 times price to book. None of these markets are that stretched from a valuation perspective. So if we look at our stoplight system, we'll see Thailand, Indo, and Malaysia are the key green markets. The red are India, Phils, and Taiwan. So that's how I look at Asia and how to allocate across Asia. Let's talk about Thailand. Within Thailand, we need to decide what sectors we should be exposed to or not, and then we need to decide what stocks to buy. Now, the interesting thing about Thailand, I've said it before, is that the unemployment rate is so low in Thailand. It's the lowest in the world. It's under 1%. Now, people may dispute that, but here, right here, I can look at the latest data that we have across regions within Thailand to see that every region is almost at full capacity. And this is even including the fact that we have more than 2 million documented and undocumented workers coming from surrounding countries. Now, this chart to me was really shocking, because what you could see in this chart, the bottom number is about 10 and 11% for Thailand. And what does that mean? Over the last 5 years, the domestic economy in Thailand has only grown by 10 to 11%. That's the lowest in Asia, and that is the total. That's not average per year. That's the total for 5 years. Every other emerging country in Asia has experienced much higher growth. So though we have seen a boom in consumer stocks in the market, my argument is that the consumer in Thailand driving the economy is going to continue to be a very strong force, and it's going to keep Thailand's economy going well. So if we look at it, we can see the jiggly line that's falling is the unemployment rate going down to under 1%. And the other line, the orangish line, is actually the rising wages. Now, we did have a government increase in minimum wage that happened by about 40% in April, and we've got another one that will come in the next 6 months or so, so that we'll continue to see wages rise. Wages rising with a low unemployment rate, people have money and they want to spend. Let's look at poverty levels in Thailand, and we can see that the poverty level has fallen pretty dramatically, a lot like what's happening across all of Asia. But in the case of Thailand, we also see that real per capita GDP is very, very significant. Now, part of that's because we've had the move that Vietnam, for instance, is going through right now. And that move, I call it from farms to factories. And that move from farm to factories can be seen by the fact that the agricultural contribution to the Thai GDP is tiny now compared to where it used to be, and it never was that huge. But that's a lot of factory output and production. The last thing I want to highlight on this chart is that motorcycle sales continue to rise. People have money in their hands. So if we look at the domestic economy, the good news is that consumption growth should continue for a long time. The bad news, unfortunately, is that consumption or consumer stocks are expensive. So the first opportunity we have is to try to look for some consumer exposure that's not expensive. And I have 5 stocks in this portfolio that I believe are the best consumer plays that I can find that aren't expensive. MBK, Jazz, Tisco, SCB, and Macro. And so if we look at the sectors in Thailand, I'm overweight telecom and energy and underweight consumer sectors. And this, again, is based upon fundamentals, valuations, and momentum. My stock picking strategy has finally been revealed, and here it is. After putting a lot of effort into my stock picking, I've made some changes. Right now, I'm taking out Thai Airways and the Tesco Lotus property fund, and I'm replacing that with MBK and also Delta Electronics. If any of you have been to Bangkok, you know that MBK is a big shopping mall where people are spending money, not only tourists, but also Thais. This is the consumer exposure I'm getting at less than 10 times earnings with MBK. Now, The last thing I would say is that I've been running this portfolio since January. The portfolio's been doing reasonably well, in line with the market. Recently, we've taken off a bit thanks to Staycon, one of our picks, Jasmine, and also the Tesco Lotus fund has been up quite significantly. So this tells that we've been doing reasonably well right now. Let's hope that we can hold on to it with our new movement into MBK and also our movement into the other stocks. So for that sums up the report for this week. I want to say thank you for listening and see you next time.